Welcome to Cherry Beckert Industrial Manufacturing and Consumer Goods podcast series. We aim to explore this dynamic world and discuss the operating challenges facing manufacturers and offer new ideas and solutions. Join us as we uncover growth strategies and enhance after-tax cash flow in an ever-evolving industrial and consumer goods landscape. Welcome to another episode of our Industrial Manufacturing podcast series. I'm your host, Reyes, the Industrial Manufacturing and Consumer Goods Leader at Cherry Beckert. And today we're driving into a powerful financial strategy that many manufacturers overlook, but can significantly improve cash flow, fuel reinvestment, and strengthen long-term growth. We're talking about cost segregation studies. What are they? How do they work? And why are they especially impactful for manufacturing facilities? Joining me today is Daniel Hurtado, Martin Karamon from our tax credits and incentives team. Welcome to the show. And would you please introduce yourselves to the audience?
Yeah, Luis, this is Martin Karamon. It's good to be here. I am in charge of tax credits incentives advisory here at Cherry Beckert, also known as TCIA. Our team works with companies from really all across the country to capture tax incentives that they've earned, including R&D credits, cost segregation, depreciation, energy incentives, and state and local credits. I've actually spent most of my time in this space, and the one thing I'll tell you is that manufacturers are consistently among, I think, the most underserved when it comes to these benefits, because often they don't even realize that they're entitled to them.
And Luis, this is Daniel Hurtado. Good to be with you this morning as well. I work along Marty in the credits and incentives team. Specifically, I focus on cost segregation and fixed asset studies. My background is in engineering-based studies, which means I spend a lot of time in manufacturing plants, walking production floors, looking at electrical panels, and occasionally getting strange looks from employees and plant managers. Also wondering what a tax guy is doing and being so excited about concrete pads. But that's where all the money is, literally embedded in the walls and the floors of the building.
Let's start with the basics. What exactly is a cost segregation study?
I'll take that, Luis. It's a great question. And when a taxpayer buys or builds a commercial building, the IRS basically dictates how long we can depreciate the entire building, which is typically over 39 years. And that's a long time to recover your cost. So if you spent $10 million today on a new manufacturing facility, the IRS is basically allowing you to deduct only $256,000 of that cost on a yearly basis for the next 4 decades. That's like paying for a Ferrari and only being allowed to drive it on Sundays. So a cost segregation study is going to be an engineering-based analysis, which is basically going to take that building cost and tear it apart component by component. So we're going to identify specific components of the building that don't need to sit in a 39-year depreciation schedule. Things like special electrical systems, process piping, equipment foundations, dedicated HVACs, reinforced floors, even everything outside the building like site improvements, parking lots, fencing. All of that can be reclassified in either a 5, 7, or 15-year recovery period.
And then to kind of like build on that, what Daniel was saying, the real power for that 5, 7, and 15-year property is with bonus depreciation. So under the One Big Beautiful Bill last year, also which we call OB3, bonus depreciation has been permanently restored for qualifying assets acquired after January 19, 2025. So those components he just mentioned, the ones that we reclassified to 5, 7, or 15-year property, can now be fully expensed in year one. So you're not waiting 39 years, you're not even waiting 5. You're pretty much taking the entire deduction the year the property is placed in service for those components that have been segregated out.
Another way to put it is, I think of it, I've never met a dessert I haven't liked. So if the IRS gave me a whole pie and told me to just eat one slice for the next 39 years, well, a cost segregation study is going to allow us to identify the pieces of that pie that we're allowed to eat right now. And for manufacturers, it's going to turn into a very large portion of the pie. Truly, you're going to enjoy it immediately. And I'd like to also add just one more nuance. This isn't just some aggressive exotic strategy. I've been specializing in cost segregation studies now for 30 years, and the IRS even published an audit techniques guide for cost segregation studies to help the field examining agents. The most recent update was published just this past year in 2025, which basically it's their playbook for telling examiners exactly how a compliance study should look. When we conduct a study, we follow the IRS own rules, and we're not just making sure our clients are leaving deductions on the table and treating everything like 39-year when the tax code says otherwise.
Why is this especially relevant for industrial manufacturing companies?
Well, Luis, this is where manufacturing really shines. And basically, what manufacturing facilities are going to do for dollar, it's the single best property type for any taxpayer, and especially for a cost segregation study. And those are going to be based off of two big reasons for that. First, manufacturing plants are infrastructurally dense. So they're not like a Class A office building where we're really just trying to differentiate between drywalls and carpets and nice lobbies. A manufacturing facility is going to be loaded with heavy duty electrical distribution systems. It's going to have a lot of process piping, usually reinforced concrete pads for heavy machinery, even overhead cranes and some of the building structure to support those. Special ventilation and dust collections are just a few things to think of. All of that infrastructure is going to be built to serve the production process. It's not necessarily for the maintenance and operation of the building, and that's exactly what qualifies for accelerated depreciation. So industry data shows that manufacturing facilities typically will achieve 40 to 50% or higher of the depreciable basis to be reclassified into a shorter life category. So for a $10 million facility, if you imagine, that means 4 to 5 million of it's going to be first year depreciation deductions.
And then I guess I get to talk about the cool thing, which is QPP. So this is a brand new, incredibly, I think, exciting extra asset class, qualified production property that's specific to manufacturing. It was created again under OB3, the One Big Beautiful Bill. It's Section 168N, and it truly is a game changer. Traditionally, as we talked about, cost seg reclassifies components out of the 39-year bucket into like 5, 7, or 15-year personal property. But the building shell itself, like the walls, the roof, structural components, those always sort of remained in 39-year property. QPP changes that. So for the first time, certain real property, the actual building structure that's used as an integral part of the qualified production activity can now be fully expensed with 100% bonus depreciation as well. So we put that in perspective. Before QPP, if you build a $10 million manufacturing plant, a cost seg might reclassify $4.5 million into short life property. That's great, but the remaining 5.5 of building structure was still stuck at 39 years. Now with QPP, if that like remaining structure is used as an integral part of manufacturing, the production floor, mezzanines, etc., a significant portion of that 5.5 million can also immediately be expensed. So we're talking about potentially writing off 70, 80, or even 90% of a manufacturing facility in year one. That's unprecedented, but it is a temporary incentive that only lasts for a few years. We'll see if that doesn't get extended at some point in the future. But Daniel, I don't know if you want to say any more.
Yeah, and here's what even makes it more interesting specifically. To qualify for this QPP category, we also have to look at qualified production activity. So it's not going to be everything in just because it's a manufacturing facility. We're going to have to define and think of it like where is there going to be substantial transformation of tangible personal property taking place. So that's going to be like converting wood pulp into paper, machining steel rods into bolts, or molding plastic pellets into auto parts. Those areas in the building is going to what's qualified. There's going to be certain areas that don't qualify, like warehousing space, where you're storing finished goods or administrative office sales portions of the building. But the IRS is essentially saying if you're building things in America, we want to reward you for investing in the facilities where this is going to happen.
And one thing to note, though, QPP does only apply to the production-related portions of the facility. So office space, administrative areas, finished goods, warehousing, and sales departments, they don't qualify. But there's a helpful de minimis rule. So if at least like 95% of the facility is used in qualified production activities, you may be able to treat 100% of the building as QPP. So for a manufacturer whose facility is almost entirely production floor, the math gets very favorable. But doing a detailed cost segregation analysis is where we really make sure that we're doing the homework to I guess allocate as much to QPP as possible.
That's right. And that 95% threshold rule, that's very manufacturer friendly. So if we can qualify 95% or more of the facility as production space based on the activity taking place, we can treat the whole thing as QPP. For a lot of plants that I get to walk through, the office and the desk in the corner of the coffee maker, those have seen better days. Those facilities are almost certainly going to clear the 95% bar threshold.
Let's break down the big benefits. What should manufacturers care about most?
Well, I'd frame it around three pillars. First, we're going to look at cash flow, reinvestment, and competitive advantage. So if we take them one by one, first, cash flow. This is the headline. When you accelerate depreciation, you're reducing your taxable income in the early years of ownership. Lowering taxable income means lowering taxable liability, and a lower tax liability means more cash stays in the business for the owner to invest. For a manufacturer that spent, again, $10 million on a new facility, a well-executed cost segregation study combined with the QPP is now going to generate 2 to 3 more million in the first year of savings, tax savings that is, depending on the tax rate and how much a facility qualifies. That's not a paper benefit. That's going to be real cash back to deploy immediately into the business.
And then I think that leads to what we would call like the second pillar, which is reinvestment. So manufacturers are obviously capital intensive businesses. You're constantly reinvesting in equipment technology, like workforce capacity. The cash freed up through cost seg doesn't just sit in a bank account. It goes right back into the business. I mean, I've seen clients use first year tax savings to fund new production items, upgrade automation systems, invest in R&D, hire skilled workers, or even acquire competitors. It's sort of what they call a virtuous cycle. Invest in the facility, accelerate deductions, and then redeploy the savings into like the next growth initiative.
That's right. And the third pillar is going to be your competitive advantage. Think of it, which I think of as being underdepreciated. If you're a manufacturer and your competitor down the road is doing a cost segregation study and you're not, they're effectively operating with a lower tax cost of capital. They're reinvesting faster. They're going to be upgrading sooner and compounding those advantages year after year. In a tight margin industry like manufacturing at times, this is going to be the kind of edge that really matters.
You know, I want to highlight a benefit that goes beyond cost seg itself, but like when you're working with manufacturers, we're not just looking at one incentive, and this is kind of the power of like tax credits incentive advisory. We're not just looking at cost seg, we're looking beyond that. We don't look in isolation. So for example, for manufacturers, we also look at the research credit, not to get too far afield from what our topic is, but you know, most manufacturers don't realize they're already doing qualified research every day. So when your engineering team designs like custom tooling for a product, when your process engineers run trials on a new material or alloy, and when you're troubleshooting like a quality issue and systematically testing different solutions, all that can qualify for R&D. And that's something we're always looking at while we're doing a cost seg as well. It's a different analysis, it's a different benefit, but it's something we like to sort of pair up in this space. That's what another reason why cost seg is so important in manufacturing. All the credits really do hit manufacturers.
Marty, that's absolutely right. The beautiful thing that we do in cost segregation, R&D, and really in all of our tax credits and incentive services is they're complementary. They're not necessarily competing. Cost segregation study is going to accelerate deductions on your facility investment. The R&D credit is going to provide a dollar for dollar credit against your tax liability for wages and supplies and other contract research that tied to innovation. A manufacturer who does both is essentially getting rewarded twice for investing in the building first, where they're going to begin innovating, and again for innovation itself. It's like the IRS is saying, thank you for building things in America, and here's a coupon and a rebate to take advantage of.
And like just one more point on OB3, on that R&D point, you know, prior years companies had to capitalize their R&D. They no longer have to, so they're really just looking at a credit when they look at this. So that's a true benefit on top of the cost segregation without the capitalization. So I just wanted to get into that. Daniel, I don't know if you want to talk a little about 3115s.
Yeah, one more thing here to mention, that it's easy to overlook as well, that it's not, a lot of times we speak with taxpayers and clients that it's something that's occurring right now this year, but there's always an opportunity to look back and see what's been missed. So if you built something in the past, purchased it, renovated it, manufacturing facility in any prior year, never did a cost segregation study, or maybe it's been a few years and there's been additional remodels and other additions that have occurred, we can still recapture those missed deductions. The IRS allows us to do it by filing a 3115. We do not have to amend any tax returns. So if there is missed opportunity, we can catch everything up on the current year return with that form 3115. So we routinely find that for most manufacturers who've owned their facilities, say for 5, 10 years or so, and they have six-figure deductions sitting unclaimed, it's like finding money in the couch cushions, except the couch is a $20 million production facility.
Hey, Daniel, question for you. So what do you think is the best time to do a cost seg? For me, I think it's the sooner the better, but like from your perspective, what do you think when it's within the, I guess, the cycle of the build?
Well, I want to be clear. I mean, it's never too late. That's a very common question I get. It's kind of when's the right time? And I always say it's never too early, but it's also never too late. So if you built a facility 5 years ago, 10 years ago, even 20 years ago, you never did a cost segregation study, or it's been a while since you've actually looked at your fixed asset register, there's always going to be opportunity still there. As we mentioned, the 3115 gives us that look back mechanism, but also the earlier we get involved in the process, if you're building a new facility or moving to a new location, there's going to be additional credits and incentives that we can take advantage of, along with the cost segregation study as well.
Yeah, and I think the sooner the better as well to look at it when you're planning to see if you can really get the full benefit of those QPP deductions or even the cost segregation, because there's some nuance when these rules flipped into bonus depreciation regarding when you began construction versus when you place it in service. So I would just say the earlier the better to make sure you're modeling that out and understanding the facts and developing it appropriately. Oh yeah, and one more thing with QPP specifically, the timing is defined by statute, and so construction has to begin after January 19th, 25, and before January 1st, 29. And the property has to be placed in service before January 1st, 2031. So if you're a manufacturer who's planning a new facility, an expansion, or major renovation, you are sitting on a sweet spot right now. And there are also a little different rules. If you acquire property as well that was never used in manufacturing, you can bring that in most likely to a QPP analysis as well.
And one more, I guess another consideration just to make sure we cover in all bases here. So this is cost segregation study is going to generate large deductions, and deductions are more valuable when you have income to offset it. So if your company is in a loss position, accelerating depreciation just creates a bigger loss, which you can carry forward, but you lose time value of money on the deduction. The ideal candidate is going to be a manufacturer that's generating healthy income, has made a significant facility investment, and plans to hold the property for at least 3 to 5 years.
I think bottom line for manufacturers under this current tax landscape, it probably is the most favorable we've seen for manufacturers. Between 100% bonus depreciation, QPP, and restored immediate expensing for R&D under 174A, which we didn't talk about specifically, but that's the provision that allows you to currently deduct your R&D expenditures with a permanent R&D credit. There are just multiple layers of incentives that all work together, and our job is to make sure that clients are capturing all of them. So because the only thing worse than, I guess, paying too much tax is not knowing you paid too much tax.
This has been incredibly insightful. Thank you both for being here today. For manufacturers looking to optimize cash flow, fund growth, and improve returns, cost segregation represents a powerful but often underutilized strategy. To our listeners, if you're investing in facilities or planning expansion, now is the time to evaluate whether a cost segregation study could benefit your business. Be sure to subscribe for more insights in tax strategy, operational efficiency, and growth in industrial manufacturing. Thank you for listening.
Thank you for listening to our podcast today. For more information, visit our website at cbh.com/manufacturing, where you can give feedback and connect with our professionals. If you enjoyed this podcast, please subscribe, leave a review wherever you listen to your podcasts, and share with your colleagues.